Last year we sold 17 in total and we acquired about 18-ish.
What?
Yeah.
That's Bawar Ahmad, co-founder of Ecomma, a company that buys, grows and sells micro-ecommerce stores for massive profits within an average of 3 months. In the past 4 years, Bawar has flipped over 40 stores and there is no sign of slowing down.
If you look at private equity in general, the multiples really increase because the competition is high. But on the micro level, there's almost hardly anyone really bidding on those business. So for us, it's very easy to get good deals.
In this episode, Bawar reveals how to find value and buy great stores at bargain prices.
We love what we call evergreen industries, which is industries that we don't expect to go away very soon. We generally buy between 1/2 to 2 times multiple.
How to instantly add profits and increase the value of the store.
Cost optimization, just take the P&L, go line by line, start with cost of goods and try to negotiate all the costs down. That's one. Second, it's
how to get multiple purchase offers to sell your store.
The moment we launch it, within a month we get the first 4 or 5 offers and it takes another 2 to 4 weeks to actually close.
I mean, while most investors are struggling to, find the one store that fits their buy box, I mean, some of them are waiting for 2-3 years. In the same time of span, you have flipped 35 of them. So how do you find these businesses to buy, which is probably the hardest thing, when it comes to business acquisition?
The biggest problem buyers have is that they want the perfect business. In e-commerce, there's no such thing as perfect business. They all have some things that are red flags, that are not perfect. And I think as an investor, you should have that into the thesis. So a lot of buyers, you just go for one business and it has to be perfect and everything and they put all the money towards it. Well, I would argue, don't do it. Have enough capital to 5 small businesses. So if one even trembles, so be it. We found our businesses, the best deals we have are just online marketplaces. We have a very strong position. I think if you just even Google, you'll find 20 marketplaces for digital assets. So if it's Flippa, if it's Acquire, Buy by Sell, whatever it is, you have 20 of them probably worldwide with hundreds, if not thousands of listings coming every month. We just scrap and list those daily. So we have a team just going through all the deals and we filter very easily. We don't have 20 filters to go through. We have 3, which is revenue, as a decline or rising revenue. We have numbers. We look at the numbers. We look at if it's up and down, and we look at the industry. That's it. Those 3, we have it. Great. We talk. We usually make an offer real quick, and negotiation starts. At the end of the day, you're looking for a good deal. That's also when the money is made. You don't make the deal. You don't make the money when you sell. You make the money when you buy the business. So we are just very on top of it. So for anyone who's wanting to buy the first business, just go to marketplaces every day, set 20 minutes on the site, just open your laptop, go to the website, do 3 filters. Don't go 10, 20, 30, 40, 50, 60, 100. 3 filters, look at them, just reach out, have conversations with them, have meetings. And if it feels good, just make the offer, make the step, start negotiation and go from there. But it starts with just doing.
Is there any specific industry you look for that you think, is doing really well?
Yeah, we love what we call evergreen industries, which is industries that we don't expect to go away very soon, like children, fashion, beauty, home and decor. As long as people wake up, eat and sleep, they will want to have clothing to wear a day. Women will always have to want to invest in their beauty, and they will have children, which they want toys for. And we love toys very specifically because parents, they don't really save money on the children. So you're an industry which has a very high margins, very high repeat customer rate. And if you have the first time parent, you can easily upsell them more. So we love the children industry, but as well as home and decor, because usually when someone moves to a new home, they end up spending spree. So they can easily spend more. They can easily throw around another couple of $100s on a new lamp, for example. So we love home and decor as well. And the third is, I think, is fashion and beauty. And the fourth is usually electronics and stuff like that. But yeah, we love evergreen industries that just don't go away very easily.
It's almost like sell the need rather than the want, right? Find businesses which are actually selling the need. So it's evergreen rather than, just selling something cool. So when it's trending, like people buy it, and after that, it just goes down.
Yeah, I wouldn't even argue it's about the need, I would say, because we have a lot of products that just want products, like nice to haves. I think it's more about the market you're in. Like we look at four things generally. But the first one is a rising market. Like if you start selling newspapers, like the business is dying out, so that wouldn't make sense. Is it a good market? Is it is the audience easy to target? So if you sell, I don't know, diapers to grandmas and grandpas, those are very hard to target on online. So we don't like those. So we like the ones you can easily find the audience. A third, is it an audience that has money? So if you go after jobless people and helping them to find a job, like even though they love the product, it's a great market, it's easy to target, those people are not very rich, don't have a job. So don't really wouldn't spend much. And fourth, how big is a pain point? And that's only the fourth point we look at. The first three are the main ones. If those three align, usually if it's a must-have product or like must or nice-to-have product, we still take the bet. So yeah, I would not even argue that the need is the biggest thing in e-commerce, especially the first three are like the most important ones.
Like you mentioned, like you could just find a bunch of platforms on Google, the M&A platforms. I have looked at a bunch of platforms, like couldn't find some good deals. Maybe, as I said, I was looking for the perfect business. Is there any top platforms you would suggest for the audience to, where you have found some good deals? I mean, you've done like 35 deals now.
Yeah, we love Flipper. Our best friends at Flipper. We have very good contacts with them as well. I think a lot of deals we do just come through Flipper. Not necessarily because they have, on average, better deals. They just have high volume, which you can easier find better deals on average than any other platform. So having a good relationship with Flipper, being on top of it is very strong. Usually the listings you see that are online for a very long time, those are not the good deals. But if you're on there daily and you're very quick on finding the first deal, those are the diamonds in the rough landscape of micro M&A. Because if you're soon, you can get them off the market, you buy it, you close it, get them on the LOI, and you move from there. So many times that we saw a deal after 48 hours and we lost the deal because someone else already had them on the LOI. And we were like, oh, damn, such a good business. So speed helps on Flipper. And Flipper's our main partner.
So I think it's almost like you got to be super active. If a good deal comes on market, it's gone within a day or so.
Yeah. Oh yeah, you gotta be quick. So many times that I could hit my head against the wall because we lost such a beautiful business for such a low price. So yeah.
So from what I've seen with most of I have looked at your deals, right? So when we're trying to sell it. So from what I've seen, most of the acquisitions are like mainly drop shipping stores or like private label stores. And along with that, most of them are kind of based in Europe. And also, like when it comes to drop shipping stores, I think the best stores I have seen with good numbers are actually from Europe. So when you're getting started, like was that the main strategy? Like, hey, the European stores are the best one, let's go with it, or it just came through experience?
Yeah, I think because the European has more opportunity, US, same as any market, has more demand. So the pricing for your businesses are slightly higher if you look at the same financials in your business, because just general, there are less people speaking Italian, for example. So Italian businesses have just less valuation than US businesses. So I think over time, because we're just very strong in Europe as well, we're also very strong in US. But given the same level of strongness, there was less demand for businesses in Europe. So for us, we can easily snatch some good deals there. And we are very strong in Europe as we know how to expand to neighboring countries. So you also have to play your skills. We know the European market, we know the languages, we have good systems to play with the languages and the translations. We have a lot of advertising partners, content partners in Europe, which helps as well. But it doesn't mean we just focus on Europe. We love both, but the better deals, I believe, they're in Europe, just because there's less demand for those businesses.
Based on what we have seen, right, especially with dropshipping stores, the competition is super crazy. And like in the US, you kind of have to like spend way more money to get the same amount of returns to when we compare to the European side of it. I mean, based on what I've seen. Do you think is it still possible to apply the same strategy what you guys are applying for US-based stores, like buy it, like grow it and flip it, especially dropshipping stores?
For this level, yes. Because they're in essence all the same. They're on Shopify. You run Facebook ads, Google ads, you run email marketing, you try to add some products, increase average order value. You play the same game, basically. You have the same value drivers, the same add-ons you do to those businesses. If it's Europe, if it's US, it's the same. Only Europe is a bit more complex because you have a bit more language barrier. You might have, a bit smaller market. So, how much can you test? You have a little bit of it with the products from Asia that takes not a very efficiently sent to Europe than as it is to US. So you have a bit of, hurdles, so to say. But in all honesty, it's the same strategy. It's the same core business, same way of getting the customer, same way of looking at the business and managing the business with same KPIs to follow. So we have the exact same playbook for US.
So you just have to play with the KPIs and make sure, that the unit economic makes sense. So just curious, do you guys have any Europe, US based stores that you're running right now? Or is it mainly Europe?
Yeah, I think close to 30% should be US. Yeah.
Cool. So since you're flipping based, to the audience, I asked him hey bro, can you send me some of the examples of deals you have done? He literally sent me a Google sheet with all the deals he has done, how much they bought for, how much they sold for, when they bought it, how much profits they made. It's insane. So based on what I've seen, on an average, you guys flip within 3 months, right? So according to my knowledge with business acquisition, especially when it comes to the value add aspect of it, people try to look for the track record of how long that particular strategy you have implemented has been working so that, they could pay a higher multiple. So as you guys are flipping it within 3 months, I feel like the price you buy plays a huge role, in the value add when you're exiting it. So I was just curious, what is the average multiple you guys pay for the stores you're buying?
So we have, if you look at the market, an average is shorter time frame for holding businesses. I think between 3 to 12 months, 12 months being probably one of the later ones, and 3 months being one of the sooner ones. So for us, multiple arbitrage, it helps. Add value to the business, it helps. If you're going to negotiate costs down and we can show it hey, for the next 12 months, we've added just 20K net profit just because we have less fulfillment cost, it helps and add value. But if you also have we can buy under market value and we can sell it for market value, you have multiple arbitrage. We generally buy between 1/2 to 2 times multiple. That's basically it really depends on the size of the business, on what they're doing. Is it single products? Is it sustainable? How old are they? But let's say between 1/2 to 2 times a yearly profit. And one thing as well is that I think also big add value in this multiple arbitrage is that usually the business we buy, they are solopreneurs. A lot of investors and buyers, they don't want to buy a business that's solely dependent on the owner. The owner does the marketing, the owner does operation, the owner does customer service, the owner does everything. So if owner goes home, business loses home. So that's where we just come in, that we don't have that risk because we feel very confident in running a business. So we can easily take it over. We don't need to take a look at the risk. We use it for negotiation, but we don't take it in our investment model. We buy it, put our team on it, and the moment we go for exit, there was less dependency on the old owners because there's a team of veterans running the business, which is usually a huge USP for buyers, which also created multiple arbitrage.
Are you guys willing to go higher if a deal is good, or 0.5x to 2x is your average multiple you're sticking with?
Yeah, so we have multiple funds. So if Ecomma 1, Ecomma 2, Ecomma 3, Ecomma 4 is coming, and we have Web Street 10, which we are quite recently partners with. For Web Street 10, we do bigger businesses, we do higher valuations. We wouldn't be weird to do 3 or 3.5, but that would be the maximum. In general e-commerce, I believe 3.5 is already stretched out. So yeah, for smaller ones, I think 2 is the max. And then for medium size, let's say more than 200K in profit, it's close to 3.
One of the hardest thing or challenge you could say when it comes to buying a business is valuation. So how can someone make sure they are not overpaying for the business what they're buying?
So a good example of valuation is the next following. Let's say a business does 100,000 in profit yearly basis.
and you think the business will grow 20% per year. So after year 1, it's 130,000. After year 2, it's 144,000. So the next 2 years, it will most likely offer you 260,000, more or less. The way we like to think is that, okay, how much cash on cash return do we want to make? Like how much money do we want to have tied up in the business by acquiring it or working capital to get that 260,000 the next 2 years? Well, we aim for 40%, for example. So then if you take the 260 and divide it by 1.4 for 1 year, and there's a second year, in this case, divide it again by 1.4, you get to roughly 100,000.
130,000. Yeah.
You get to $130,000 because if you put in $130 into the business, which is again not only valuation, it's also part of working capital requirement. You put $130,000 into the business valuation. After 2 years, looking back on that 130,000, you get 40% return for 2 years. So in this example, we might say like, okay, the business needs 28,000 in working capital. Because you have to have money in the bank setting, you have to have some inventory, you have to have some outstanding balances. You still wait for the receipt. You have some working capital, like if you buy a car, you have some fuel into the car. So let's say this example: 130,000, 20,000 working capital. It means you would buy the business at 110,000.
Got it. So in terms of you said 2 years. Is there any reason like why you only like project it towards like just 2 years?
Yeah, you have to look at for your own example. So if your thesis is to hold for 5 years, use this example to do for 5 years. If it is for 3 months, it's for 3 months. If it is for a year, it's a year. So for us, we like to think always between 1 to 3 years, as it's easier to forecast what will happen in 1 to 3 years. Because if you said now, I think, okay, in 5 years, what the business do from now on this size is pretty hard, and that's why 1 to 3 years is usually the better forecast numbers. So that's why when you value business, we just like to say, okay, what would you expect for the next 1 to 3 years? That's how we value the business.
So in terms of when you look at profits, for the valuation, are you looking at the profits like before taxes or is it like after taxes?
We look at after taxes and our jurisdiction in our country. So we look at taxes, what it will mean to us if we would own it. So let's say we are in a US and the business is in Germany. Because you're an US entity making the profits, you have different taxes than if you're in Germany. And for us, the cash return is still the same. We want 40% after taxes. So if it means that we have to pay 10% on the profit yearly as taxes, and we see this as cost when we make the forecast for the P&L. So we look at what it means to us after taxes.
You mentioned the working capital. So can you make it a little bit more simpler for the audience? Like first we could go with like what exactly is working capital because people sometimes get confused. Is it like, hey, we have to look at operating expenses for let's say 3 months and then use that as a working capital or like how do you go about it? Like maybe first give an example, like what specifically when you say the working capital and how do you like go about calculating it?
I'm never a big fan of seeing working capital as an amount per month, per week, per day, because every business is different. Like some business even have negative working capital, and some have like, if you calculate in months, like 6 months worth of expenses. The way we look at more is easy to understand if you look at the balance sheet of a business, because you mostly do asset purchase agreements and we don't really have access to balance sheets. So we're like, okay, we think back to us, like if we would own the business, how much money at any given point would need to be stuck into the business, which means inventory is usually a big portion of it. So let's say you have in cosmetic brands and you need 10,000 of lip gloss products sitting in a warehouse at any given point. It's either between 10 to 20,000. So that's an average is 15,000 you have in stock. So $15,000 you would have to need to be sitting in stock. That money is stuck. Second is Shopify, PayPal, Klarna, Afterpay. On these pay providers, they don't pay out instantly when a client base. They pay out delayed, sometimes 3 days, sometimes 7 days. We try to understand at any given point how much is stuck with payment providers. Let's say, for example, it's roughly 7 days revenue. So then we end up 7 days revenue. This case might be $10,000. Then you have 15,000 in inventory, $10,000 stock on payment providers. And for example, you have another 5,000 you just want to have sitting in the bank, just in case there is some holiday and delayed payments, whatever there is. You have another 5,000. So then you're at 30,000 working capital needed. And that's how we think about it. If, for example, it's a dropshipping business, you don't have inventory, it's already half. And if, for example, you have a credit cards like Amex, or you can delay payment terms, so you don't have to pay every single thing on the day that happens, but you can pay the advertising after 60 days, I'll let you get working capital back. Because then you don't need as much money stock, because you're getting basically a credit from these vendors, which then you use to have it in the inventory, to have it in the bank, which can even come to negative. So it's also, when you buy a business, you can also think about, what can I do to reduce the amount of working capital needed? Do I need better inventory management? Do I need better relationships with payment processing companies? Can I negotiate the payment terms? Which I'll give a hint, you can usually. You can just ask simply like, hey, I want another 7 days, another 30 days payment terms. Most people say yes. If you go to Meta Ads and you go to the building a payment section, you have an option after a while, usually, as a, hey, I apply for credit line. Which basically means that for the ad spend of a given month, you get the bill at the end of the month and you have 30 days to pay it, which is like a huge portion of free working capital you get. So you can also optimize this. But before you buy the business, just take it as it is. And that's how we calculate.
So is it safe to assume it's almost like, let's say, 1 month of, working capital?
I would say on average, if you look at our business we have done, it's between 2 weeks to 3 weeks. Also because we know how to optimize it. But again, in some cases it's like negative 1 month. Sometimes it's like 6 months. Because, for example, if in a home and decor, you need a lot of inventory sitting. You have big payments, which is always getting stuck somewhere. And if you're a little bit not fast shipping, this PayPal might say like, hey, we're going to hold 20% of your funds. So you also need to finance that somehow. So we have a case where like 6-7 months. But on average, that's what we usually, with expectation of going to a deal, is between 2 to 3 weeks.
So it's basically whatever the asset is subtracted by the liabilities, and that's kind of like give you the working capital.
Thanks. Yeah.
Would you say your part of your strategy is like buy slightly distressed stores where there are like bunch of missing pieces or a little bit distressed, but that you could just pull some levers, add very quick value to exit them, rather than just like go on finding like the perfect one possible? And also, I think because as you are going for that, I think you are able to get like way lower valuation compared to other businesses.
Yeah, quite honestly, every deal is distressed. If you have look in the micro private equity, nothing's perfect. They all have some issues. They're all either too centered around the product, too centered around one channel, too centered around one person, too centered in one market. Whatever it is, they always have like issues, some more, some less. So I don't think so that we just really focus on distressed deals. Of course, if there's like a cherry out there that has their own product, their own patent, their own everything, and they're investing, they might not fit for us because they expect high valuation and doesn't really fit our buy, grow, and sell quickly thesis. But honestly, if you go to Flipper, I can put my hands down, 99.5% distressed. They have some stress somewhere. That usually buyers, they come in with the idea that there will be one with this, where there's no stress, a perfect deal. They won't. They will just make random offers, and then after they see the stress, they just pull back, which just help us, the ones who understand the stress and who can work around it and take the stress with it, and happy to take the risk because we're confident in what we do. It just helps us to reduce the price if those buyers are looking for the ones without stress. So for the listeners, don't look for stress-free businesses. So be open for that.
So I think for this model to work of buying, flipping micro-ecommerce stores, I think the buyer, whoever is buying, should like have a pretty good like operational background. It's not like you just buy a business, put someone in, and just like magic happens, right? Or like at least have a partner who has that operational strength.
My advice would be, if you have no skills, so you don't know marketing, you don't know operations, you don't know anything about Shopify, whatever, buy the business with an earnout. Work with the old owner, give them a 6-month earnout, a good portion of the value, maybe even like half, like 50%. Increase valuation, so be it, but just work closely with the owner and really shadow him so you can basically take the learnings from him on how to run the business. So if you have no skills, you don't know marketing, you don't know operations, you're just very bad in everything, just put a high earnout in there, talk with the old owner. Just make sure you like sponge, take all the information you get from them, copy paste, make Loom videos on what they do, make documents, ask them to make SOPs and everything else included. Because then you learn it. If you have skills, you're good in marketing, you know operational, you don't need it. The sooner the owner leaves, usually the better. The old owner leaves, usually the better. But without anything, just give an earnout. And you'll be surprised that the old owner, they really fight for earnouts. They really do their best. And you can really use this in your advantage by just learning as much as you can during that period.
So, like, what percentage of earnouts do you normally do, like, for these kind of deals?
We are between 20 to 50% on average. I think 60% is just cash and 40%, and 40% is in cash deals, 60% is earnout deals with 20 to 50%. And the more risk we see, the more uncertain we are. For example, we are not very strong in SEO. We are not very strong on getting social media marketing. So if we have businesses that are very reliant on those channels, we just put a higher earnout in place. We learn, we take everything from them. Perfect, very happy. We may even pay the earnout sooner, and we just take it over and go from there. But the less confident we are, the higher the percentage of earnout.
That's amazing. So just curious, like many people try to find that one partner who complements each other's skills. I mean, based on what I've seen with you and Vigor, so Vigor is more of like the M&A guy, and you are more of like, I mean, you also do M&A stuff, but more on the operational side of it, and like you're pretty good at that. So, like, is there any suggestion you'd have for the audience where, they're looking for their partner? Maybe it could be an operator, or it could be, they could be the operator and they're looking for someone who's really good at M&A and stuff.
You're asking the guy who had like 7 failed partnerships through his life. So the things I learned is that you only need a partner if it's one of the 3 things. Either they have the money you don't have, or you have the money and they don't have it. Either they have the time you don't have, or the other way around, or they have a skill set you don't have and you need to run the business for. And during my whole career, I was a very operational guy, very strategy driven, and less about sales. I'm not bad at sales, but I don't enjoy it. I don't get energy from it. And to do sales, to do very good at it, you really need to love conversations, meetings, getting after people, getting the follow up. You should really love it. I just don't. And Wigil really had that from day one. He had like multiple traits he really succeeded in, but the biggest trait he had that I didn't have was around sales. He loved talking about people. He could have like people sitting on his lips, listening to him for hours and hours, and just walk away saying like, take my money. Like, what is bank account? Let me just transfer it. As well as one thing I'm very grateful for, and this is something I really emphasize for everyone looking for a partner: find a partner that pushes you, that pushes you to be more. And Wigir has a very strong focus on speed. Like the moment he calls me 5 times a day, he asks me like, hey, can we do it now? Can we do it today? Like he has this push in your back that, makes me just want to do very quick. And I push him as well. Like, let's try to close the deal. Let's go for it. Let's try to think bigger. So having a partner that has a skill set you don't have, as well as pushes you to be best in what you do, I think that's the best mix to have. Third, most importantly, it's also the connection. Eventually you work with a person a very long time. You should the basic relationship between people. You should have trust. You should have the same values, hopefully, similar lifestyle. Like if one is into partying, one is like already settling down, it's going to be very friction wise because you make different choices for the business. So just, look for everyone who has the same lifestyle, same values, and especially the same vision. And that on top of the skill sets, and he's pushing you, then you have a great partner. And I've learned that after my 8th partnership during my lifetime. Yeah.
Finding deals is really hard. That's the first thing. And getting them at the price we want and the terms we want is like the hardest. How do you, you mentioned that you go for like higher earnouts if you feel like it's more riskier. How do you go about, getting the seller to give you the price and terms you want? Like, do you have any specific strategy you use?
First of all, volume. So it's a volume game, same as sales. You get a lot of no's, but someone there you will get some yeses. So volume helps a lot. Second, work with the broker. At the end of the day, the broker is included. They just want the deal to happen. They don't really care about price. They just want the deal to happen. So if you have like a little bit of good contact, like, hey, broker, nice to meet you. This is what we are. This is what I do. I think good fit. I hope it is the first of many. they're way more inclined to even reduce the price or help you reduce the price with the buyer just to get the first business or first transaction going between you two. So work with the buyer, work with the broker, get them on your side. It helps a lot. That's the second. And then the third is, again, rationalizing. Rationalizing. Like, this is why we think this is why we don't think we get any better deal. If there are solid risks, we use those as well. Like, hey, you only have one SKU, it's a risk. We already see that the product's been declining, so the thing that doesn't worth much. I don't have any returning customers. You have bad reviews. You have like a lot of this stuff that just make it less valuable. Usually they understand. And what happens a lot with potential sellers is that they might come with a price in mind, but the moment they launch it, they understand, what the value is and what the price is, and those are not very aligned. And they start dropping the price very quickly after. And what I've seen, if you just come with a rational mind, like, hey, I like your business, but these are the risks I see. This will all impact our value thesis about the business. This will all impact the future cash flows, and this is the risk we put into it. And that's everything's half multiple. We never get a bad response. You just negotiate, like, understand, and then you try to give the pros of the business, and you just simply negotiate. But never we get like a bad reply. Wow, well, that doesn't make any sense. But we usually get like a positive feedback. They understand, and they just go from there. Plus, focus on speed as well. Like, okay, if you accept, give us 2 weeks of diligence and we close. Like, people, they also value getting the funds as soon as possible. Sometimes it's less about the amount, sometimes more about the terms. So if you can be flexible around the terms, like you can pay quick, you can pay in wire transfer, without escrow, with escrow, you can fly to them, you can reduce the earnout or whatever it is, then you can also, negotiate in your favor by having the price less, by just giving them better terms.
Real quick, guys, each of these episodes represents over 30 hours of my personal work, not including my post-production team's time. I'm building this podcast to become the number one resource for business acquisitions, and the only way that's going to happen is through your feedback. So please drop a comment with a timestamp for the parts that you found valuable or not helpful. If you're on audio platforms, you can leave a review. This will help me understand what you like, what you don't like, so I can create exactly the content you want to see. Thanks for your support. Now back to the podcast. So have you had situations where, you just gave them a price and they didn't agree to it, and then, you came back and they were still sitting on the market, and, you even got at a better price? Is this something happens a lot, or?
I would say a good portion, for sure. 10 to 20% of deals we've done came like that. We made an offer. The guy said, well, I've got so much interest going on, and I'm like, the other ones are double the price you're paying, so we'll keep on talking with them. I'm like, sure, let us know. 3 months pass by, and they come back with one simple message: are you still open to buy? ? And we're like, sure. Tell me what happened. Well, at that time we offered 70,000 in cash. He said, well, it didn't go through the blah blah blah. So can we still work on 70,000? And we're like, okay, send us updated P&L. I would just find something, to push down. Like, well, that month wasn't very good, or hey, the cost is one increase, so we can do 50. They're like, can we do 60 at least? I'm like, okay, fine, you can do 55. Fine, deal, and we push it through. So we love those moments that they come back, and it happens quite a lot because there's so much. As much as rubbish businesses are out there are as much as, probably even more, rubbish buyers out there that just make offers, show interest, have super enthusiastic, and just disappear for the buyer. And nothing sucks more, of nothing hits the psychology more of a seller when they have a lot of interest and they just all pull out one by one. Like, mentally they sold the business, but they still have it, so they're probably willing to take even lower offers just to be done with it. Yeah.
Is it safe to assume that as a 10 to 20% happens like that? So the rest 80%, is it like, hey, you looked at the deal, you thought it was good, and you just sent them an offer, and they kind of accepted it, and you just bought it within a couple of hours or a couple of days, 2 or 3 days?
Yeah, people are very surprised by how quick something can go. We saw a business, we ask information we want, send us P&L, we have a list of questions we send them, we made the offer, a bit back and forward, 2 or 3 days, we accept, perfect, great. LOI, we might exchange 7 messages. perhaps sometimes even without a meeting, sometimes just one meeting, and that's it. We have an LOI, we can start going. So people will be very surprised to see how quickly these deals can go.
Like on an average, like how many days does it take from you contacting them and like you actually like closing it?
Yeah, I think the faster ones are usually within like I'm talking about LOI signed. So then due diligence is just fixed at 2 weeks, and then 1 week of contract and closing. But until LOI signed, like the sooner ones are like 3 to 7 days, and the longer ones when they come back is like 6 months. But also on average, what we can expect on when we do a deal is that we contact them first 2 weeks before we send LOI. It usually goes very quick.
So you said like after it takes like 2 weeks for the due diligence?
Yeah, we do. We used to do very quick, like, oh, a few days is enough, 1 week is enough. But we've learned, better to invest a bit more time in due diligence, already start adding value to due diligence, already working on strategy, already get everything sorted just before closing. It's just better, because after you close and then you ask all the questions like, hey, owner, now what we can do? The old owners, less incentivized to really help you out. Like the due diligence, they're happy to do everything. They will fly to you. They will give you a massage if you ask them. They will do everything for you. But after due diligence, they're like, I don't know, I'm busy. I have one meeting a week, and then they try to reduce it. So they say, you know what? Let's extend due diligence to 2 weeks, like intensive 2 weeks, like almost every day you spend like an hour, 2 hours on the business, and then we go from there.
So it doesn't matter how big the business is or how small is it, like 2 weeks fixed, you just do it.
More or less. If there's sometimes complex components to it, like they have self-fulfillment or they have some kind of third-party influencer marketing agency that, is very important to the business, it might take a couple of days more, but usually within 2 weeks, you've covered operational due diligence, you've covered financial due diligence, you've covered legal due diligence, and lastly is also about the marketing. You cover everything, and it just takes 2 weeks. Yeah.
So, I mean, one of the things I've seen with like Flipper or any other platforms, if the deal is good, the sellers sometimes don't even accept an NDA. Maybe they look at your profile and they're like, hey, like I think he's a time waste. I'm not gonna, accept it. Like, do you have like any suggestions for the audience to kind of like stand out of the crowd and, to be taken seriously by the buyer? Like any magic message you send it first and, they're like, oh, here are the details.
I always like to say is that as much as you think a business has to be sold to you, you have to sell yourself to the seller. So they should also feel comfortable with you. At the end of the day, doing a deal, it's a lot of emotions involved, a lot of human psychology involved. So if for the first moment, you can, let's say, establish yourself as a good potential buyer, that helps a lot. So usually in the first message, throw out a compliment. I like your business. I like what you've seen, but be specific. Don't just say like, I like your business. That's it. No. From the business I've saw from you, I like that you done Facebook ads for a very long time, very stable spend, and the ROAS is very strong. Like if you show a compliment that you really thought about it, you really put effort into it, it's usually very appreciative from sellers. Second, to also give a little bit of intro. My name is Bawar. I am the co-founder of Ecomma, where we buy and sell businesses. We've done 40 transactions over time, and we love to investigate yours to see our potential see this potential fit for the next deal. So let's say if you're, first time buying, you might even say like, hey, I have 10 years of experience in marketing, and I saw your business, I like the market aspect of it, and that's why I'm interested in. Like throw in those little subtle hints that you are a strong seller and buyer. That helps a lot.
I think I have to change my message. So I have a message where it's basically, I have the track record intro and stuff, but it's almost like copy paste. The only thing I'm personalizing is the name. So I think I'm going to have to change that.
Personalize. It helps a lot. If you because at the end of the day, same as cold emails or any message you receive, it feels more relevant to you, you're more likely to take it more seriously.
Speedy is one of your superpower. And something most investors struggles with, right? That they kind of like take forever to do the due diligence and stuff. So, what's your typical due diligence looks like?
Yeah, we have a long checklist, but as a first-time buyer or even your second, don't bother doing it. Just keep it very simple. Our due diligence is very simple. First, foremost, most important is financial. So, does the P&L provided to you actually is accurate? So the way you feel most comfortable verifying it, that's what I would recommend. We like invoices. We like access to the Shopify accounts, to the marketing accounts. We like to get access to everything, see the actual costs being done. We also ask for bank statements, and usually you see that around bank statements and stuff, they won't supply because they have one bank account for personal stuff and everything else. So just, give them 100 transactions to go after. If it's Shopify payouts, Facebook costs, whatever, just get those input. So financial, very important. Really sit down and really be tough on this one. We are really tough on this one. Second is operational. You want to speak with everyone involved on the business, not only freelancers and customer service agents, but as well suppliers, 3PLs, marketing agencies. Everything is involved in the business. You want to speak with them, and you want to be very thorough in those conversations and be like, okay, hey, how long have you been on? Are you happy? So very important, they're happy. A lot of times when we had the conversations, they were like more or less saying like, we're not happy with either the salary they have, the amount of work, whatever it is, they have some kind of dissatisfaction, which is very risky. If you take over, they start asking for salary increases, which impact your, investment thesis, and they want to leave because they were not happy, they're working too much, they're, getting pregnant, whatever. So satisfaction, what they actually are doing. So a lot of times they have maybe staff members that just don't do much. So you can see for add values there, or they do it just too much. So they're very reliant on one person, which can also increase the risk. So on that part, I think those are the most two important points to look at. And all the questions usually revolve those. And the third is, of course, like legal. Are they actually the owner? Are there any contracts? Do they have any issues? We have had a few times, which is hard to do due diligence, but we could have found it better, is that you ask if they own everything on the website, like images, pictures, logos, products. Because like once or twice that we got like a DMCA Shopify takedown, because they were they had a picture, they copied it from a competitor. So just Google reverse Google image. I think it's called, like you can Google search an image on Google to see if like someone else popping out. Do those for most important pictures, so you feel like it's fine. And then a part of it as well is just around customers. Like we love to see actual reviews. A lot of people, they say like, oh yeah, we're very good, happy customers. Look at the reviews on our website, but you can just filter those to however you like. So if you log into the review management, you might see all the 1 stars. Go to Trustpilot, check those. Call a few customers like, hey, how did you experience it? We always call SBR customer survey feedback center. We usually ask around delivery. We ask around quality, and we ask about expectation. So okay, those 3, like how do you experience it? Usually around the pricing as well. Do you think it's worth, what you paid for, and eventually what you got, what you recommended to a friend? They're just simple questions, and you'll be surprised that usually they're very honest. They're like, well, I bought it. I thought it was 2 days. Actually took 5 days, which was a bit unfortunate, but it's fine. I can cover with extra days. Actually the packaging was very bad. It was very cheap. I felt like it came from China. The moment I opened the packaging, the product was very nice. I liked it. And I tried it on, didn't really see the results as they were promised on the website. It said like took me 2 weeks to lining my hair color, for example. But actually I did it for 2 months, and only then I started to see like big of change. So maybe that wasn't communicated very well, and just give you the honest tips, and you have this normal human conversation. You take it down and you do it like 3 to 10 times, and you usually get a very strong insight around the business. Very important to randomize those people. Just don't go less 10 orders or only the woman or whatever. Just really randomize in the last 90 days, 10 orders. Just find copy the orders, put in some randomized tool, get the 10 order IDs and start calling those, so you don't get biased by any underlying correlation between them. I think doing those parts, you've done like 90%. And also recommended, everyone has different focus areas. Do double due diligence for the things that are important to you. So if you are very focused on marketing, just make sure the marketing is very strong. So take extra time there. Take an extra look. If it's Facebook ads, take a customer feedback score. go a bit deeper through the ads, maybe even hire an external advertising expert, just give you some tips about, if everything is well around advertising, if they didn't do some, shenanigan, let's say, hiding comments, deleting comments, having a lot of people complaining or reporting them, like whatever it is, just make sure you have those. And then you have a solid due diligence.
That's a lot, but we give the steps. That's important. And you mentioned that, just talk to all the employees. They are like suppliers and stuff. One of the common objection you're going to get when we ask that to a seller is like, hey, you could do that once you buy a business, or like, what if, you don't buy us out, and that's going to kind of create some issues with the employees, because like, they will know that like the owner is selling the business. And that's like a common objection you're going to get. Like, how are you going to kind of like handle that? Or is it like a non-negotiable, like, hey, if you are not open to this, we can't buy your business?
Yeah, for us, very strict, it's non-negotiable. If we can't speak with someone involved in the business, we are out, because we don't trust it. Where there was smoke, there was fire. If for whatever reason they don't feel comfortable, as they're afraid, if the team knows they're selling, it will impact the business, then we'll be fine not saying we're potential buyers. Then we're just an external consultant looking to investigate around the business, see how we can improve the business. So we are happy to like not even mention that we are about to buy the business. But for us, it's very important to have these conversations. Without these conversations, for us, we don't go through.
Yeah, that's an interesting way to think about. And one of the things I always tell any investors I work with is that no matter what kind of due diligence you make, you spend like a month on it or a year on it, once you buy it, you always figure out some problem that you didn't find out, during the due diligence. You have a proper structure of the way you guys do due diligence and stuff. But still, like, were there any situations, like any like stories where, like you missed something and you figured it out like after buying the business, after doing all kinds of due diligence?
I do have a story that we almost bought a business that was like a big scam. So we only do Shopify stores, on Shopify stores. One time we said, why not go outside of Shopify? Big deals, let's go for it. Like, okay, let's go try it. We found a business on BigCommerce. So a guy was in car industry. We look in, we made the offer, some negotiation. It was even very tough. Like, okay, eventually we got a deal and we started due diligence. And we were so close. It was early on. We didn't do too much due diligence at the time. So everything made sense. We looked at BigCommerce, we saw the revenues, the traffic, all made sense. Orders made sense. And, we did running ads, everything was well. So then I said, okay, let's do the deal. But before I do, I always want to have like one last check. Just quickly get a feeling like, do I miss something or not? And I went to the order management on BigCommerce and I was looking through the names. And some of the names were very weird to me. Like I saw, for example, John Doe. I'm like, it's actually a person called John Doe. And then I saw like another John. I'm like, how many Johns are there buying, car parts? So I started opening up these things, and what I saw is that the credit card they were very similar. Like from the 10 orders I did, for example, 3 different cards were used. So 3 different customers were using the same card, basically. I was like, very curious. How is it possible? I started looking a bit more from which IP these people placing the orders, from which location, which address they were sending to. And what I found out, the current owner, he was at break even, claiming he's making 70K in profit, but he was actually break even, and he just was making 70K of orders to himself just to show the profit. I was using fake names, the same credit cards over time. And yeah, everything made sense. Like the revenue was like, let's say 40K, and he was actually making 40K top of it, but he was always making 50K, but placing himself the last 10K of orders. So we were very close. Fucking found out, confronted him. He disappeared, of course. And we didn't go through. So we've had like big almost missers before the diligence, but after diligence, we never really had big stuff. Maybe only one, that we bought the business not knowing that they were doing a huge sale for the last 2 months. So we did everything. We saw the business. I think we saw the business in January, and we want to close in February, end of Feb. And once we close, we got over the business, and then we stopped the sale because it was the end of the sale. and the business drops. And apparently they've never done a huge sale like this before. They just want to sell out of all the stock they had before selling, which hit the business very hard, because it's very hard to go back from you selling it was in jewelry business. You sell something for 20 euros to now normal price 40 euros, like double the price. It's very hard to go back. So that's sometimes we've learned from it. But other than that, we never really had big misses after.
So were you able to turn around that business, or it just tanked?
Oh yes, we had like 2 months of a hole in the P&L, but eventually we got it more or less the same as it was, and then we luckily sold it. And to this day they're still doing fine, but they would have done way better if the idea we had of the business was true.
Just a quick, if we go back to the due diligence part of it, I had a quick question. Are there any like common red flags you've seen like multiple times that the audience has to be like aware of?
Definitely. First of all, is declining performance. Is that the moment you get access, you see how stuff is going down. Second is marketing account issues. So they have a low customer feedback score on Meta. They have disabled ads on Google. They have some issue basically going on there. Third is that the people involved in the business spend way more time as they sold it to you. So the owner doesn't do 15 minutes of Facebook ads every day. He does more like 4 hours of Facebook ads management every day. They miss one-time cost, like creative cost. They send free products to customers. They have some chargebacks here and there. They usually miss those as well. That's a very common one. Images that they don't own the image, or they copied an image from a competitor or like a video or something that just is very risky. I think those are the common ones.
Like when you look at the declining performance, so like normally I just say no to them. Like that is something I learned from you as well. If it's declining, we don't even look at it. But one of the things I've seen buyers do is like, hey, they were doing so much money. Basically, the seller would give them a reason, like, hey, this is not working because like the past 2 months were down because of some random reason, right? They give some random reason. So when I talk to these investors, like suggesting them like, hey, it's not a good move, they are like, oh, the store is doing good. I mean, there's decline because of XYZ reason. So like, what do you say to such investors, like to buy it, not buy it, or what would you do if you were in that position?
Yeah, for the investors, you pay for the past, but you buy the future. So even though they might have done very well in the past, you buy the future. And if the future is down, then you can, as any forecaster would say, then the forecast would also be down. So what happened last year, it's in the world of e-commerce, a huge difference. Like last year is like ages ago if you do like any other business. So whatever happened last year, it's almost doesn't help anything to say what happened with this month. So the closer the period is to the moment you buy, that's way more reflective than a year ago, 6 months ago, 7 months ago. And usually when there's a decline, no owner would consciously let the business go into decline because they wanted to, they had some issue, they solve it very quickly, whatever it is. If it's in decline, usually the trend just keeps on going. Like just focus 101, follow the trend. If it's down, it's down.
So another thing with the business, like Facebook ad accounts, right? So another common thing I have seen is that like we have dealt with this issue that the seller has like multiple stores and the same business manager, and they can't like transfer the business manager. Like, would you buy such stores, like, where they're like, hey, like I can't like completely transfer the business manager, but I'm happy to, just like add you in as an agency partner for my ad account? I mean, there's a lot of risk there, but would you do that, or like how would you go about it?
For us, non-negotiable. We don't get a Facebook business manager, we don't proceed. Because as long as they own the pixel, the ad account, they basically own the main asset of the business, which we don't want. So, and usually transferring everything to a new business manager never goes well. Performance always drops. So it's not worth doing that as well. So if you don't get a business manager, it's no deal. If they have multiple ad accounts, then we suggest them to have a new business manager and transfer everything they have as much as they can to the business manager. But we won't proceed if we cannot have the full ownership of the accounts.
Of course, you have done multiple deals, so you know like what to look for, what not to look for. So would you suggest like the audience who are looking to buy a first business or second business to probably hire a professional to do the due diligence, or like what do you suggest there?
If you have no experience, definitely don't go out yourself. Don't just ask things. It's very hard to miss so many things. They're great people. If you take an e-commerce due diligence on Google, you have probably like 5 people. They just make amazing due diligence reports. Like people who wanted to buy business from us, they have hired those people, and I know how strong they are. I think one's called Rapid Due Diligence. So shout out to them. They make a very nice report. They really dive into everything very thoroughly. Costs a couple of thousand, but they really find every little dirt that's there. So I would, if you're unexperienced first-time buyer, you don't know what you're looking for, definitely get an expert involved. Just Google a few of them, ask, the best proposal, negotiate the price, and give one the go to due diligence.
Makes sense. So I mean, one of the thing the buyer's gonna think about is like, hey, I'm buying the store for let's say 20 grand. I mean, do I really have to spend like a couple of grand on just doing the due diligence? What do you say when someone says that?
For 20K, wouldn't be worth it. Then just watch some YouTube videos and understand how you can do some due diligence. But let's say around the 50K mark, get a partner involved.
So now back to the closing part. Do you do all the deals on platform itself, the closing and stuff, or do you use like a escrow.com, or how do you go about that?
Depends on the platform itself. Like Flipper is always done on Flipper. They have very strong service. If we have a deal, we can make the LOI there. We can we make our own asset purchase agreement. We sign, we upload it within Flipper, and then we start Flipper Pay, which is more or less like the escrow service. We wire the funds to there. We get the assets, and then we tell Flipper to release the funds. If it's without Flipper, a different platform, usually escrow is the way to go. We always want to use some kind of middleman, as it really protects you. You don't want to, get screwed because in the wire transfer. If you use some servers like Flipper Escrow, you're way more protected, and the small fees, a couple of $100, is more than worth it.
So I think one of the thing like that's cool about you guys is like you kind of like fly down like when you get a deal done and like get a deal done in person. Like, do you do that for all the deals or only like select a few deals?
Yeah, we do that when we exit the deal. So when we acquire the deal, we just care about the speed. So escrow, Flipper, don't need to fly, keep costs low. But when we exit the deal, we also do face-to-face. We believe business is done face-to-face, especially when you exit and you build a long-term partnership with the new owner. As well as if you use escrow, it doesn't have the best reviews. It's very protective for the buyer, less for the seller. So if you want to exit the deal, you want to protect our own interest, we like to just give you everything. Are you happy? Please let's proceed to the wire transfer. And not the other way around. If we buy a business, we want to protect ourselves, and using a middleman, it's mandatory for us.
What does your contracts look like? I mean, is it like 1-page, 2-page document, or you have like more, a little bit complex, or like any key clauses, like it's a must for any contracts you're signing?
Yeah, for sure. I think our contract is close to between 12 to 20 pages. It's pretty extensive one. We have all the standard ones, so always make sure they have. They mention that the business, as all information they provided, is accurate. It's well. There's confidentiality. I don't want, if we ever sell the business, that the buy price will come out, which doesn't help you in negotiation. I think all the standard stuff are usually in there. That we get our supplier. We have the asset list included very thoroughly. There are penalties if they don't do very well. The transition period, it's in there. We have the payment terms. If we have an earnout, we really clearly define the earnout. Indemnification, like I believe all the standard stuff in there. For us, especially in UAE, we also want to make sure they can do business in UAE. So you also have like a part of the contract saying they have a good standing in UAE, they have no issues. They are the owner at the moment of the signing the contracts. They are at that time the owner of the business. So you have basically all the standard ones in there. Yeah.
So I think you gave us a lot of couple of things, and you gotta have in the agreement. Is there any like one or two like key important things, or like, hey, whatever you do, you have to have this, 2-3 things in the contract?
Non-compete. Strong one. Always have non-compete in the business. We suggest 2 years, but the minimum is 1 year, depending on what they will say. So you would have definitely a non-compete. And just every warranty there is, so that they own all the copyright, they have no issues. If there's a DMCA, for example, we have in a contract as well. If there's a DMCA takedown within 60 days of all the stuff we have things, they get a fine, for example. So we add all those places as well, but I think non-compete is more important. The payment terms, of course, should be in there. And just every little risk that's on the business, just add those. Because one thing we have seen is that the ones that have issues, they come back on those points. Like, oh, I don't want to have a fine on the MC takedown. I don't want to have a fine on this part, because that's where the smoke is fire. That's a bad sign for us. So you put a lot of extra warranties and guarantees and stuff inside. It really helps to understand what the business, what the owner is worried for. And then you can decide if you want to pursue or not.
Just to follow up on that, do you buy, like, whichever business, like whichever country you're buying your business in, do you also have a registered company in that specific country?
No, we have one entity in Hong Kong that we used for all our international portfolio businesses.
Especially when you're doing international deals, and let's say the buyer, like let's assume the buyer is in US and he's buying an European store, and he don't have any business in any entity in the Europe. I mean, if you're buying like a smaller business, let's say for 30-50 grand, the contracts they are putting in, like, I think it's not going to be that binding, right? I mean, even if it's binding, like if something goes wrong, you can't just go and fight him, in Europe, or like how do you go about that? If is it just like, hey, you gotta just do a pretty good due diligence, or
we never really had a situation where we had to go after something. So I'm very happy to say that. We also, when you buy the business, at the end of the day, business is people. You have to trust one another. If you speak with a guy and you don't trust him, just don't do the business. So eventually, also buy business from people who we're happy to do business with. So that's already a big step before getting yourself into trouble. Second, around legal, once money is released, if they live in Romania, good luck. Never gonna get it. Probably for bigger amounts, it's worth it. If it's like 200K, you can easily go after it, but usually still no. What we do though is that we go complaining by the broker. If there's a broker involved, we usually put the broker's name on it, like, hey, you gave us the deal. If that would be the case, we never had happen, but that's how we go about it. You give us a deal, we got screwed, somehow go solve it. And because the name is on it, they usually will help out some way. Just do very strong diligence. Also really helps.
For the buyer who's probably looking to buy his first business or like his second business, is there any lawyer or someone do you suggest where they could get their contract done, like without costing a fortune, or any other resources?
So the first time we used a lawyer, but after that we basically used our own team to add and go back forward, and we had a lawyer double check if it's legal and sound. They just proofread it basically. And lawyers, I've never had a good experience with them so far. So I would have no one to recommend for. I would just recommend any corporate lawyer that's in your area. Just Google them, go pass by them, see if it's a good fit. See if they don't work on hourly basis. We don't like hourly basis. We always move away from hourly. Always say fixed price, fixed amount of work, yes or no. So for lawyers, be aware that you don't get your blood sucked from them, because they can be the worst. They can be the best in your situation, maybe they can be the worst as well. So I've yet to find a great lawyer. I love to use their name on the podcast, but yeah, so far just be mindful of who you choose as a lawyer.
So now we are done with the closing part of it, basically the buying aspects of it. So the next step is basically when it comes to like once they buy a business, it's gonna be like the operational part of it, right? So one of the thing I have heard you say that is like during the due diligence itself, you start planning for your operational part of it. You start the preparation, like even before buying the store. What does that look like?
Yeah. For every business, doing diligence, we make a game plan where it contains all of our value drivers. Very simple example. The first one is cost negotiation. Doing diligence, we talk with the supplier, we talk with the fulfillment center, we get overview of all the cost, and we look for opportunities. For example, most owners, they just go for 2-3 suppliers, they ask for proposal, and they choose the cheapest one, not knowing that the cheapest one is still negotiable. So if they're charging you $10 for a glass, you can easily get it down to $9, $8.50 by just simply sitting down with the supplier and negotiating, or get better terms, or find even alternatives. Like, hey, we found 3 competitors, asking for less. So just simply looking at the cost structure, already have the first value driver, is making plan on what you can negotiate for. So doing diligence, we already have like a 10 value driver plan. Like, okay, for cost, we can focus on the products, we can focus on software, we can focus on fulfillment center, because we might know a fulfillment center does it cheaper, because we have a lot of business with them as well. So we can easily add values. So that's the first one. And the second is the marketing. Like, okay, we have access to Facebook ads, great. Cost, they align with the P&L. But now what? Can we do it better? Or they only have one campaign and one image with one text. Well, what if we launch 5 images every week, spend $200 on it? What will happen? Oh, perhaps we can increase the ROAS. Oh, they have only Facebook ads, but no Google ads. A lot of people, they're searching the name and coming back to the website. So you know what? Let's try some search branded, some Google Shopping or PMax, and let's include those. Oh, they have 100,000 email list, but no one is sending emails to them. Let's start implementing email campaigns. So we basically have already the plan ready before we buy. Sometimes we already have negotiated some costs. We already found an alternative that the moment we buy, we can just quickly move over to them. So yeah, for us, the actual operations is as simple as look for value drivers, the things you believe you can strong at and you feel confident adding value to the business, which so most of the times, if you do cost, you will do a big portion of it. Marketing is second, which marketing you can improve. And then extra channels. We love B2B, we love wholesale. You have a lot of platforms, Amazon, marketplaces you can just list your business on, which can get another few sales coming, which again just helps with the net profit. So we have all the plan ready. We ask the old owner, like, hey, do you agree with us? Do you think this is all doable and manageable? They might say yes. They might say, well, this is too ambitious. This is very strong. And then we can use that as well in our financial planning. But that we have done with due diligence, we have to plan the moment we take over, which is have a checklist, negotiate cost, this is the target price, get one order from B2B within a month, get the first influencers posting with more than 100,000 followers, get 6 new creatives within 2 weeks. We have the simple checklist for the team to just follow, and that's our execution.
Yeah, that's a great one. So you mentioned about, the email lists and stuff like that, right? So do you just create those checklists as you mentioned, or you just go in depth with the strategy as well? For example, let's say we take email list. So would you just put like, hey, we could send this kind of emails to this and make X amount of money? Or do you even like draft the emails for that specific store?
Keep it very simple. Just 8 emails next month. And then whatever the operations guy is going to execute, they can freely use their own creativity and their own execution strategy. They just have to send 8 emails. And after the month, usually then you give feedback, you look for KPIs, you optimize the thing that you're doing. But by making game plan, keep it simple. If you go too much in depth, you can get very easily lost on one point or get stuck or feel less motivated. Well, I have to make the email, I have to make the copy, I have to make the subject, I have to make the template already, but which software we will use and this. No. Just 8 emails. The moment you buy, the first email will be sent after 3 days and the other 7 will be before the end of the first month. Just do that. Even if it's a bit less, just do it. Like, don't get less motivated. Don't get too much in process and templates and overviews. Just get stuff going and keep the game plan very simple. Our game plan, it's 1 page, 2 page. Just 10 points, goal, 3 goals, and we just have a checklist to finish it. It's very simple.
What is the reason behind like why you do this? Is it to speed up the process, or is it to like have 100% conviction that hey, there are opportunities, once we buy it we could make money, so it's a good investment to make? Like what is the like main reason like why you prepare, even before buying it?
Yeah, it's speed. Even though we've had businesses that we said like, well, everything is already pretty optimized, which also for us is very confident. Like, oh well, then the business is strong. The owner knows what he was doing, so we can just continue the business as is. But for us, it's most about speed. The moment I acquire, I want to just immediately get stuff going. The sooner we can get the values to the business, the sooner it increases the value, the sooner we can make our money back, get a high cash return. So for this, for a good example, speed matters. We do it for speed.
Speed is like one of the key thing with your investment thesis, like why you are able to like flip things faster. So this completely makes sense. The next thing I want to talk about is basically probably one of the hardest. Once you buy a business, is like transitioning to the new owner to make sure it doesn't break. I mean, you mentioned that you leverage earnout to make sure the seller is invested as well. Can you go a little bit more in depth in that particular thing, like how the transition happens and like how many hours, the seller is spending with you, like what exactly they're doing and stuff?
So during diligence, we already spoke with the team. Our team already spoke with their team. We already spoke with the owner. Our team spoke with the owners already. A lot of things on the business has been clarified during diligence. So it's very important to use those as well to get as much information as you can, because during that period, the owner is most willing to give the most information. And at the moment we close, there are 3 meetings, 3 days after the closing. So the first day after closing, there's a meeting around operations. The day after, if it's the weekend, it's going to be on a Monday, is a marketing meeting. And then the third, it's others, whatever's involved around the meeting. And then we have usually a weekly meeting, and then we ask them to make them Loom videos. We literally show them how Loom works. We ask them to make documents, whatever they teach us. Okay, make a document. Sometimes they're not very, open and willing to really put effort in. So, okay, you know what? We'll have a meeting. We'll make the document, but you just tell us what we have to put inside. So we have, in the first few weeks, we're very hands-on and just get all the information we need. Usually after 2 weeks, we have everything we want, just to be sure we keep the old owner for a month, 2 months. So we get all the information, and then we can officially take over. We usually have the idea of first month, we shadow you as the old owner, and second month, you shadow us to see if we're doing everything well and nothing is being missed.
That makes sense. So basically they're incentivized through the earnout, if I'm not wrong.
Yeah. Yeah, definitely earnout. Yeah.
Like, did you have any situations where you actually paid them as a consulting fees or something, or is it just like straight out earnout?
Yeah, it's either earnouts, but usually even without earnouts, they're usually very happy to help as well. And again, it's about a person for the first 2 months to help out.
Okay, so with the operations and marketing, you mentioned like the calls you do. Is it more of like you have a list of questions or list of things you want to collect from the seller, or you're just collecting from them, or what does it look like?
We have for marketing a brand insight template. It's one document we have containing 15 questions about who should audience, how do you target them, which sales are you running, your hero products, the main USPs you have. Like we have this general question on marketing because that's the most important. Around operations, like okay, if you have inventory, what's inventory management? What's the sales outstanding? Get all the information going. If it's customer service, about the ticket systems, how do you use it? What's the templates you have, the documents for copy pasting, what happens if there's a refund, a return, you send it back to you, the fulfillment center, you let them keep it, all the information. So they're very tailored, but only for marketing, we have like a very standard brand insight template, and we ask Loom videos on how they run the ads. I think those are the most common for every business. We want a lot of Loom videos of every time they log in to Facebook ads to record what they're doing. It's very insightful.
Just to speak on the finding the right seller, like I think as Warren Buffett said, like you can't do a good deal with a bad person. I mean, you are doing all kinds of due diligence, financial and all things like that. Is there anything you look for in the seller, like doing due diligence on the seller to make sure it's the right guy to buy from and stuff?
Yeah, we have no-go zone countries. So if the passport or they are from a country we just don't proceed, I won't say the countries here, but they are from the countries we just don't want to do business with. So those you have to look at yourself which countries you don't want to do business with. Second is we just look how they are doing diligence. If they're very helpful, very thoughtful, very sure, I love to give the information input, we know it's going to be good. We've had moments that due diligence, they're like very short, very dry. Like, this is the answer. I don't know. Look for yourself. Here is an invoice. All I could find, And like, you know what? Never mind. Then we just won't make the step. So doing diligence, because there's like I like to say that up until LOI, it's like the first date. It's like, you're dating, you're just like understanding each other. Okay, great. LOI is signed. You're now in the initial relationship, basically. And then until the closing, after transition, then basically you're engaged. Now, if you happen to, if you stick on, then you get married, but it doesn't go through that. So we'd like to see that way as well. Is that during the relation, during the diligence, you already know how the other person is. If it doesn't feel good, just don't continue.
Okay, so now we bought the business, we transitioned from, to the new owner. So the next step is basically like optimizing the store to add more value to it. So as you're flipping stores so quick, within like 3 months or so, you don't have time to like optimize everything. So like, what are the 3 to 4 key things like, you have seen that, hey, if you optimize these are the 3-4 common things we optimize that adds a lot of value to whatever business you have bought?
Yeah, cost optimization. Just take the P&L, go line by line, start with cost of goods, and try to negotiate all the costs down. You'll be surprised if you have a software line, for example, hosting. You can send an email like, guys, I want 10% off forever. And they're like, fine, we'll give 10%. For the supplier, like, hey, we want better pricing, or we have a competitor. Fine, they will give something. 3PL, fine, they will give something. So you'll be surprised if you just go after cost, you can easily add value very quickly to the business. So that's one. Second, it's email marketing. People really underutilize email marketing. We've yet to see a business that we bought that had such a good, strong email marketing. We're like, okay, that's it. They maximize it. They've done very well. Like simple, sending a bit more emails, a bit more tailored, a bit more well optimized, better design, better offer. It can add like another 10% revenue to the business with almost no cost. So it's very nice. It's a repeatable thing. It's a very nice channel to have. So definitely a very strong one. It's creatives, images, and videos. Usually these platforms are very social media focused, or Google Ads, where they have like some kind of banners on the website, whatever. So that's a very easy one to just have more creative output. Whatever they're doing, just keep the same process. They're getting them on Fiverr. They have some creators and free products too. They have like one creator does very well. Just do the same thing. Just double that output. Just twice as much images, twice as much videos, and you will see how much impact it will do. Pricing. Last thing is pricing. You'll be also surprised that usually a little bit of extra pricing, it doesn't really hit the conversion rate. So everything around CRO, everything you can do to increase average order value, average profit per order, or even the conversion rates. If you just focus on the CRO part, you'll be also very surprised by little changes, big impact. I'll give you an example. We had a business that was in the toys industry. They had in the cart a pre-checked shipping insurance package. So let's say the items do around like $60, $70. Once you go to the cart, you saw that like, hey, $5 has been added for insured shipping. Without this, your item is not insured. Almost everyone apparently just kept on talking on, and then they went through. And I was thinking like, isn't it like a conversion killer? Like I feel like we can do better, because I look at the amount of people who went to the cart and the amount of people went to the checkout. It was like a big drop off. So okay, let's try to remove it. Just try to remove it and see what happens. I kid you not, 40% higher conversion rate. Like simple change, removing little step, making it less friction, make it easier, 40% higher conversion rate. Like you can just overnight, you make 40% more revenue, like small changes. So you'll be surprised that around the website, usually there are a million opportunities that can really make big changes in a short term.
That's interesting. So, I mean, when you say pricing, it's not only about just increasing the price, but also look at things where you could decrease it, that could increase your conversion, make more sales. So with pricing, do you have like a percentage increase you do so that it doesn't break what's working?
Not a percentage, but on tier. So if something's 29, we try 34, 39. If something is 59, we try 69, 64. So we usually just bump it up the first ones, just see what happens, and then we just go back.
Like how long do you normally wait to kind of see the results before making the decision of whether to increase it, decrease it, or change the price?
Yeah, you have a lot of EB Shopify apps. So we don't really like just changing the price and just say like, okay, last week was this week is going to be this. Oh, we are better or worse, because it's very biased test. Like you have like a Shopify app, you can EB test it. Everyone goes to the product page. 50% will be to A, 50% will be to B, and just put the data into some statistical significance test. Just go to Google, statistical significance A/B test. You can put numbers in, amount of traffic, amount of conversions, and it will tell you if one is statistically significant better, and you go with it.
So with the cost optimization, is it just straightforward, as you said, you just go to them and say, hey, I need a 10% reduction or whatever, or we have competitors, or what does the messaging looks like when you're reaching out to them?
Yes, actually, it's that simple as that. Either we say well, we just bought the business and we know you're selling this item for $10. We look in the market and we see people selling it for $8, $8.50. So if you cannot match that, please don't have feelings. If we move forward, and usually we'll do something, or we just simply ask, we're a new partner, we're serious, we want to go long term, we see some scalability in the business, but for that we need better margins. I would just ask for it.
So what is it, once you buy the stores, what is the minimum return, you are looking for before exiting it? In the sense, hey, I bought this business at X amount and I want to add value to it until I get X price and then exit it. Do you have any number like that? Or you just go with the timeline? I have to sell it in 3 months. Doesn't matter whatever value it is. We just sell it at 3 months.
No, we have valuations, and they're a bit tough to explain because it depends on the time, it depends on the fund we're at. Some funds we just hold for longer than a year. Some funds, within 3 months is the goal. But generally, it also comes back to the 40% year on year. So as long as for every dollar we have a minimum of 40% cash on cash return annualized, then it's perfect. So we have a business, we buy it for 100,000, and we can sell it in 3 months for 140,000. We're happy to do it because that's more than 40% annualized.
Also, you mentioned you have different funds. Have you ever thought about just holding them forever?
Yeah, so the unit economics makes sense to hold if you do big businesses, because then the cash on cash return on buying and selling, it reduces. But on small level, it's more profitable just to buy, add value, and sell. Because the cash on cash return, it's quicker. The simple numbers is if you can buy and sell for 50% cash on cash return in 3 months, it's better than holding the business and getting 50% in a year, because you can get the new funds, you can start buying and then going from there. But our goal is to do bigger and big acquisitions over time, slowly but surely. And with that, we'll be less into buying and selling. We'll be more into buying and holding. I think the flip happens around $1 million in EBITDA per year, where selling just wouldn't make sense. Because selling will only get 10, 20%, because the business is already pretty optimized. There's not a lot of multiple arbitrage in there. So you might as well just hold and you get better returns from there. So that's the switch what we'll be having. It's around that mark to start holding more.
Now we are done with buying, operating it, optimizing it. So now the next thing is the selling part. So when it comes to selling, how do you make it more attractive to a specific buyer, who's looking to buy your stores?
Yeah, one is that we still manage the business for them post acquisition. Is that we still offer to have our team run the business for them, so there's less risk of owner leaving. So I think a big add value for buyers is that we run the business. They don't buy themselves a new job. They can just unleash the vision with our team.
What do you charge? Is it a percentage of the profits, or what does it look like?
Yeah, we usually have fixed fees. It depends on hourly. So we try to hit an hourly billable goal. So it could be for operations $100, could be for marketing $80, something in those lines. And usually we have also a percentage of revenue or of profit. But the fixed fees is just on hourly. So every hour that the business needs to put in the business, it could be like times $100. So if the business needs 10 hours a month to run operations, it's $1,000. And on top, we usually have like some kind of performance incentive to also have skin in the game on top of if we have an earnout, but also to show that we really believe in the business and the incentives are aligned, basically.
Do you have the same plan for your bigger funds as well, like manage it for them, or is it more of like just exit it and move on to the next thing?
No, because we like the managing as well. We've pretty recently launched this, like I think a year and a half ago. We already have close to 20 active clients that we run the business for, which on its own you create an agency out of the ground, which has own cash flow and own profit. We have close to the buyers. You can easily give them new businesses, new opportunities. So the agency model itself has been very good to us.
When it comes to like the selling part of it, I have looked at probably like hundreds of small business deals like P&Ls and stuff like that, but I've never come close to like the way you guys put together documents so professional. It could be P&Ls, it could be the SIM. You just put it in a proper drive with everything, with financial statements and stuff. Like if I'm looking to buy a business from you, like you guys have everything ready, just ready to go. Like what's your approach when it comes to like preparing these documents, and like why do you think is it like so important?
It's same in selling, same in sales, is that you don't want a one-pager with only text because visually it's not appealing. You want to have a pitch deck. You want to let the business sell itself to the new owner. Is that if you put effort into it, and usually effort is respected. So if you have a nice P&L, a nice information momentum, enough meetings, enough time, every information you've got, you keep them, the effort is usually rewarded with more interest into the business. So I think we also stand out having those, because you usually get compliments like, oh, it's amazing P&L, it's an amazing, SIM that we've created. But I think that's also necessary, because it's part of sales. Like if you have a service you're selling, you also want to have a nice presentation. You also want to have like, a strong story behind it. You also want to make it as easy as possible for someone to understand the business and just sign. And you want to be also like, professional about it. You want to be like, just my cousin around the corner who's trying to sell me cleaning services on notes on an iPhone. You want to be taken seriously. You want to be like you're in trusted hands as well. And I think with those, you really stand out.
Is there any specific things, you suggest to have it in a P&L under, the pitch deck to make it more attractive? Because, there are people who do like, pitch decks, but it's just like mainly generic stuff. They added a lot of fluff into it where they have hidden all the like 1 or 2 KPIs, right? Like that just like it feels like they're trying to hide something, or they give like a 50-page, deck of, hey, this industry, like it's growing this much, whatever. Like, is there any specific things, if you could give like, hey, this is like what you have to follow either to create a pitch deck or to create a P&L? Like, do you have something like that?
Yeah, so P&L is pretty straightforward. Just apart from last statement, we usually also add some kind of forecast with a lot of potential buyers they can appreciate. For the information memorandum, very important to just talk about the company. What's the company? Who is it? Talk about the customer. Where are they? What's the age? What is the interest? Talk about the market. It's a growing market. It's a downward market. Talk about the product. What is the margins? What do you get from? What do you source it from? What makes the USPs? And what is the ask? So, okay, we want to sell the business. This is the numbers. This is our asking price. This is how we would value business. This is our timeline, whatever it is, add those. If you just add those 5, you cover almost every question you have from potential buyers. One thing I would recommend, let's say you still got a lot of questions about something that is not in the information memorandum, just update information memorandum with those questions answered. Like if someone's asking like, hey, we want to know the supplier, which country they had. Well, in the product section, just add supplier. It's in zone A. If people are asking like, well, how does the margins work for an average order value or a single item? Well, add a table under the product about the margins, for example. So if you add continuously keep improving from whatever questions you get, you really make it easier for future buyers/leads to understand the business, see if it's a good fit, and to make an offer.
And then also, I think, like on our conversation before, I think you mentioned on the P&L with the forecast, you also add a percentage for everything.
Yes. Oh, yes. Because I've had this from a finance background. A lot of people, they see the numbers, but they want to see ratios. So they want to see, does the marketing spend, relatively go up or go down? They want to see some kind of stability and line into it. And either they have to do the work themselves, or they have to either have to do the work themselves if they ask you for it, which both is a lot of friction we don't want. So then we basically put it in so that we take away the friction.
So what if, let's say the store is not that doing great? Would you still add the percentages, or you just like don't add it so it doesn't look at it?
No, we always be transparent and as well. Like as for our side as well, if it's not a great business, we just mention it or reflect it in the price. Or like, well, this is the price we ask because it's going down, whatever. But I think honest transparency is very key in this as well. And what I've seen is if you're just honest from day one, people are way more appreciative about it. Like what I would recommend is, let's say the business is not well, we have some issues, whatever. Just once the moment we offer, just like, hey, perfect, let's start. Just so you're aware, there's already some things that are not great with the business. Love it. Like if it's as well a good honest person, like, okay, I understand. Thanks for coming forward, and then just keep it in mind and go from there. I would just be very upfront and honest about it.
And that is one of the reasons why I like working with you guys. Also, I think if you're being honest upfront, I think you still have a room for a potential negotiation. But if they have spent, let's say, weeks doing due diligence and stuff, and at the end of the due diligence, they come up with that particular thing, I think it would probably kill the whole deal because you didn't tell them about it. Is there any things you look for where you feel like, okay, like we have achieved this, I think it's like time to sell? I mean, apart from the return, cash on cash return you mentioned, is there something like, hey, it's uptrending now, probably the best time to sell? Or is there any things like that to make it more attractive and, have it sell itself?
Yes and no. Usually we always launch no matter what within a couple of months. We always go to market just because you never know what someone is willing to offer, or you've been in the right time at the right place. So we always launch it no matter what, but we know we usually sell or get the best deals when we show growth, or we are just before a high season. So just before Black Friday, just before spring, just before Mother's Day. So we know those periods usually valuation a little bit go up. So we don't buy in those periods. We buy, after those periods. So we also take use of those.
So like, what is the typical multiple it looks like, whatever you're selling?
Between 2 to 4.
4?
Yeah, I think 4 is very rare. It happened, but 4. But probably on average it's between 2, 2.5, perhaps 3. But let's say on average 2.5.
So like, what is your thinking looks like when it comes to the selling price? Is it just like, you look at the cash on cash return and then add like, hey, make sure we're getting 40%? Or what does it look like? Or you just look at the industry multiples? I mean, like buying is completely different from selling, right? Like two different thinking. So like, what's your thoughts looks like when you're like, hey, how much this business is worth selling for?
So we for us, like, we should look at what we bought it for. So for us, we don't look too much at market and everything. Some periods that we couldn't sell, or it wasn't as easy as stuff we had, okay, you know what, let's see what the market is willing to pay at this moment. But usually we just set the price on what we paid for it and how much cash on cash we want to get. And we're going to do extra room so that we can look at room for negotiation. So for us, we look more in what it costs us when we set the pricing. If we feel like, okay, we're not selling, this is too high, this is not working, or well, this way it would be like 5x multiple or something, of course we don't proceed. But I think asking between 2 to 3, it's the sweet point to ask. But then you stand out in the platforms and you get quite some leads and you can go from there.
So a few months back, right, I was doing research on, finding some good platforms, M&A platforms where there are some hidden assets that I could potentially buy at a pretty good multiple where the competition is low. So I found this platform, like it was perfect. Okay, there was not a lot of buyers, looking for deals and stuff. There were some really good deals, low competition. And then I was just scrolling. And then I saw a listing. I felt like the this is like a similar listing. I mean, I think I've seen it somewhere. I open it, there it is. Like, like your partner's name, Vegas. I mean, like, how many platforms are you guys on? Like, I mean, every platform, like I go, like, which I feel like no one knows about this platform. You have a listing there. Like, do you guys plan on like, hey, let's just take over the internet and you just like post it everywhere? Or like, how many platforms and like, how do you do it?
I love it. I love the story. Yeah, we are on more than 25 websites for every business. We have a whole list which is go through. It's exposure. It's marketing. It's you have to market yourself if you want to be found. So the more platforms you have, the more reach you have, and the more potential buyers you can reach. You never know from which platform a buyer can come or where they have the interest. So yeah, we try to be on as much platforms as possible and just showcase us. Yeah.
I think you're bringing in a lot of your marketing agency experience into this, and it's like the volume game. It could be buying or it could be selling this volume. That's awesome. So like, I know you can't give every platform name. Can you like give some platforms where you have sold like most of your businesses from, and that like the audience could leverage if that's possible?
You will judge me for this for sure. Because we, and especially my marketing background, we never really sit down and look from which platforms we get the buyers. It's very bad. Cannot imagine running a company but not knowing your own KPIs where you get the leads from. So I'm not sure where the platforms come from. I feel like it's from the main platforms like Acquire, Biz by Sell, the main platforms out there. I feel like it's from those, but I'm not sure, quite honestly. We get the most amount of leads from those. We get fewer leads from the smaller ones, but we never really keep track on, because how it works, we have like someone who manages all the platforms. Once we get a message, they just push for a meeting, and then once we have the meeting, then we get like joins in, and he has no idea where they came from. Because well, if you have per business 150 leads, you launch 2 a month, we have 300 leads. It's very hard to manage track, but actually we should. So we said from this year on, we will start tracking. So for that one, I don't have the answer. I don't have the right platform. It's very hard to say which platform is the best. Yeah.
Yeah, I understand. So basically just like list it on every platform you can find.
Yeah, the more the better. Yeah. And never assign exclusivity.
That's a good one. So with the, like, have you guys worked with brokers to sell?
Yes, they're always the worst for our side. Is that second-hand selling, even with one time with third-hand selling. So there was like someone in between, the middleman. He was selling to someone else, and he was selling to someone else. So far, not once it got through to someone else. I'm not sure why. I think because brokers have a bit more also volume game. Like they just try to give 50 businesses to a buyer and then just hope one will stick and will go through. So we've never had a situation where we were able to actually sell with someone else in between. So yeah, we're still waiting for that moment. So we have a lot of brokers who push to their clients and customers. But if it's not a marketplace, which is actually also a broker, then never really got to do something.
Makes sense. So basically brokers are good for buying, also good for selling your own stores.
Exactly.
Got it. Cool. I mean, as you have dealt with so many of these platforms, selling like multiple stores, I'm pretty sure you might have found a few hacks, where you could push your store up for the right buyers. Like, are there any specific hacks, you have found that could be helpful?
You mean to list higher on the platforms?
Yeah, I mean, anything, to make it easier for us to, present our store in front of the right buyers and make it more attractive.
Yeah, so in our business description, we already take away a lot of uncertainty of people. Like the business description, the same as like a sales letter, as your VSL, video sales letter, if you like a normal funnel, is going to be as thorough as possible, answering all the questions. So we just really try to have a very easy to understandable business description with all the stuff involved with the business that we do removes all the questions. We also re-emphasize on USPs. We run the business for you. It's cash flow positive. It's growing. It's with huge potential. It's we focus on USPs. Basically, we even offer finance or earnout options, which buyers love to just hear this because they think like, oh, they're willing to have skin in the game. They might really think the business is strong, which we do. So that helps. Second is SEO optimization. Like, what do people search for? They take in cash flow, e-commerce, or job shipping, e-commerce, profitable. Like, if you use those keywords in your business description, you already list a bit higher than the rest. Also filters. So if, let's say, the business is doing $100,000 in profit, we might put in the platform 99.9999 or 101, because you might not just hit the filter, or you don't want to hit the filter. It depends on what the strategy is. If you go for higher or low valuation, so you know how to work with the platform, how to hit the right filter. So if the buyer comes, they don't filter you out, basically. So you have like those small hacks that just might give you another 10% at least.
So it's just like the filter, just to be clear. Is it more of like, let's say if you're making 10K a month, you might add, let's say 11K a month. So it's like, it still falls between that?
And not that much, but like, let's say if it's $10,000, let's say average we looked up is exactly $10,000, we make it 10,001. Just so that if someone filters, I want a business making at least 10,000, you just filter in that. So, or even the other way around.
Makes sense. So basically, if someone is looking at a filter, the filter would be like, hey, like 0 to 10,000, 10,000 to let's say 20,000. So when you give them 10,001, even for the people who are looking between 10,000 to 20,000, it will still show you a store. Oh, that's a good one. You mentioned that, the buyers are super happy about the earnouts, and, it shows that you have the skin in the game. I mean, I feel like you're almost selling the way you buy. You're buying it at, having pretty good earnout, and also you're pretty much selling, the same way. Which most people don't. They just screw the seller and get it at a crazy price. And when they're selling, they are like, oh, we need all cash deal or else we're not selling. So what does the percentage looks like when you are selling?
Maximum 30%. So that's a max. We want to do 30% of financing an earnout, but an average probably is closer to 20. We never go higher than that because you also really want the buyer to have enough skin in the game to take it serious.
On average, like how long does it typically take for you guys to sell the business?
The moment we launch it, I think within a month we get the first 4 or 5 offers, and it takes another 2 to 4 weeks to actually close. So let's say on average, the moment we launch, between 3 to 6 weeks.
I'm pretty sure there's a lot of brokers should learn from you guys.
Yeah. Oh, God, we'll make an academy, how to sell ecom 101. We can do it together.
One of the things I've learned, like I've seen you guys do, is like I come to you and talk about a specific deal, and then maybe I get busy with something, and I come back, let's say a month or a month and a half from to ask you like about the deal, and you'll be like, oh, we got it sold. We have new one. Do you want it? I'm like, how many deals are you guys? Okay, I want to ask that. Like how on an average, like how many deals are you guys buying and selling? Let's say like every month or so.
Yeah, last year we sold 17.
17?
Total. Yeah, and we acquired about 18-ish. So this year we want to sell 24, 25 would be great. And buy a bit over that, like 28.
You're basically like buying and selling, let's say 1 deal a month.
I mean buying 2 and selling 2.
Oh, okay. That makes sense. That's a lot.
Yeah, we did a good thing for that. Yeah.
Also, another thing I had was like when you are buying, you are serious, right? But when you're selling, if it's a good deal, there are a bunch of buyers who are just tire kickers, They've seen some videos and said, okay, I can buy business for $0 down and just, Is there any specific criteria you use to kind of like filter out the buyers so you don't waste time with them?
No, but we should. We should definitely. Basically, our process, the way to protect ourselves is like we have like 1 or 2 meetings. It's like, okay, this is the information, make an offer. And once they make the offer, we already know like how serious they are, and they have to make an offer on LOI. It's not just in text message, okay, 50K plus 30K, no. Really, LOI, template, signed, fill in your name, address, the offer, really stepped out. We will want them to put work into it, so we know they're serious. And once the LOI they sign, we basically take we basically, even they may not mentally be like the best fit, they make a good offer, who are we to basically say no? So we still take them seriously. There's still a drop off there. We could easily verify or filter out bad buyers. We've had bad buyers in the past, and they're usually very risk mindset. They just should look only at the risk and the downside and just focus on everything. We're like, okay, you know what, then not, just let it be then. And just rather give to someone that's more growing mindset. That, okay, now we can do this. I see opportunity here. We can do this. All risk. I understand. You understand the risk. We take them into account, but opportunity is like what the focus is. So we should definitely do those. But I would probably say for anyone, if it's only one time in business, go with someone who asks the questions around growth. If you have someone who's just asking questions around the risk, they can make your life a hell. If you have people just more asking about growth, like, oh, what do we do? What can we, grow revenue here? What about Facebook ads? What are they spending more? What if we do more emails? Those are the best buyers to have. The best partners. I still go out with a lot of buyers I've had from years ago who bought like a second, third, or fourth, who have this amazing growth mindset. We're just happy to do business with. So choose someone who has the growth mindset. I think that's the biggest difference.
So, I completely understand with the buy side, look for someone who's thinking about the growth perspective. What's your typical buyers looks like? Are they seasoned investors or like someone, probably they're in real estate and now looking to get into e-commerce? Like, what does it look like?
I think it's 50-50. I think 50% are just first-time business acquirers, first-time investors even. They might have had a successful successful business, successful company they've sold. Usually they are wealthy people, so they are sitting on quite some capital and just want to allocate a couple of 100,000 into a new space, which is ecom, a different asset class. So usually I would say it's like first-time acquirers, but for example, Thursday we sold a business, pretty decent business for us, was to someone who have already bought 4 businesses, and then this is the 5th they want to acquire. So they're very, hands-on. We have a lot of people who like mini private equities that just had like multiple portfolio businesses and just want to add one to it. So I would say it's around 50-50. We like the more seasoned ones. They're quicker, they're easier, they understand, the business way more in depth. But we also have like 50% of the first ones, which is also sometimes nice, fresh breath of air. Someone's like very new. You have to explain everything to it, which also for yourself helps to get the business over such a way that a new person can learn it, which you teach yourself as well many things along the way. So I would say 50-50 from first time to seasoned.
The reason why I asked you was there are have seen bunch of people who came into the market like last year, I think like 23, 2024. They just put out the same offer like, hey, we help you acquire a business. Sorry, we, kind of like sell a business to you and we also manage it, performance based, whatever. So these guys were buying stores, which I wouldn't even buy it for free. They were just buying stores for, let's say, 5-10 grand, like complete shit stores. And then they were selling it for 100 grand to someone, let's say for a real estate investor who have no idea what an e-commerce store is and stuff like that. So basically they were selling them on the cash flow, like, hey, it's cash flowing X amount of money. And when it comes to real estate, as you know that, they have to spend a lot more money to get the same amount of cash flow when it comes to e-commerce. So they made like a lot of money, just selling these stores. And then within a year, they're completely gone into a different industry. I'm pretty sure you may have seen them. So like what's your thoughts on those so that, let's say if someone is looking to buy, they don't end up, buying from them. Like what do they look for? For example, let's say someone is looking to buy a store and they want to like the audience, right? Someone is an investor who wants to buy a store, but they want someone trustworthy. Like it could be you, it could be someone else. Like what should they look for before like buying it from them?
Yeah, good question. I never want to like speak bad about the company. That's if I don't know. I want to always like say like, hey, it's how they do it, and that's basically how we do it. What I do know is in the market, you have a lot of cowboys, as I call them. Just come in, try to get the quick buck, try to maximize the profit they make from you. in this market, track record is everything. Look, if they have sold 12 businesses before, but you can verify, you can speak to the old people, because, for example, we allow new buyers to speak with old buyers to, use as reference and to understand, what the process takes like. If you can do the same with them and you've done it more than 10 times successful, like, go for it. It feels good. Numbers make sense. Numbers tell. Numbers don't lie. But if you cannot, so it's the first time, it's new, you don't really have any reference, don't have any social proof, it feels a bit scammy. They might not even have they might be like all over the place, remote work, can't even have an office or team or a proper entity set up. Be aware of these cowboys, because in almost every market you have cowboys. They come in, they smell money, they try to do it for a few months, take out a couple of 100,000 and they disappear, and they are gone. Watch out for those. We really do diligence, but if it feels good, it looks good, and you can verify everything they say, go for it. Give it a shot.
Also, another thing is basically they kind of like, there are buyers or, there are sellers, they kind of like sell this pump and dump stores, they just pump it up, the like last 2-3 months, and they kind of like sell it. And once the buyer buys it, they pretty much couldn't turn on the business. So just like a curious question from my side, like out of all those stores you have sold, let's say you've sold 35 plus, right? Like how many of them are, let's say, still active, with the investors who bought the stores?
We've now sold 40, by the way. We I think 40 last week, Thursday. 4 of them are out of business. So 36 are still active. The 4 that are out of business, one was an Egyptian guy who got hacked. He got hacked and his passwords got leaked. He was Egyptian, and Egyptians generally like talking a lot. So he shared his password with his family in Egypt, and some cousin, nephew, whatever, got shared his password as well. And someone got in and changed the Shopify payout, changed the Facebook ads, what they were targeting, spending from $100 a day to $5,000 on some random product they were cashing out. So that one didn't come back from it. It's very hard to come back from that. The second and the third was also a tough lesson for us, is that we sold a business that was selling canvas paintings. So you have at home, like if aluminium glass, plexiglass kind of things. They were during lockdown, they were very booming. Everybody was at home. Everybody want to spend stuff in the home. They want to make it nicer in the home, have a nice painting. But the moment lockdown was away, the demand also was away, because everyone's going outside. No one really cared about which painting they had at home. So that was a tough lesson for us, to only go for evergreen industries and to never be in an industry that is very seasonal based, or it's depending on some economic change. Like, for example, there's a lockdown, everybody's at home, and that's why the market is booming. Don't do it. Stay away from it. So we learned our lessons there. And the fourth one is we sold the business. The owner, the new owner takes over. He didn't want to keep us on from day one, which we're totally fine about. He's the owner. He decided. We advised against it, but he said no. I have his friend in marketing, I have friend operations, and they will do everything. Okay, perfect. 6 months later, quite recently, even like I think half a year ago, he sends an email that, with much regret in his heart, he decided to shut down the business. Like, what happened? Send me the P&L. What's happening? So he sent me all the information. I did my research, and the margins, the gross margins, we were at 40. We were at 44%. They were now at 31%, 32%. I'm like, what happened? To my research, apparently the operations guy, he found a supplier who could do it cheaper. So he changed the supplier. But the supplier, he saw this owner has deep pockets. This new owner doesn't know much. Let me start increasing the price. So month by month, he started increasing the price quite aggressively, basically milking. And if you run a 20% margin and your cost of goods increase so much, it's just debt to the business. So we bought it back eventually. We fixed it, and then we sold it again. And now it looks like we have about the fifth that's like a bit of struggling. It was a jewelry business that the owner took over and also do it himself. He neglected it. Very rich guy, didn't really care. And I look back. And for us, having one failed business is like one too many. So for us, it's like, we really want to fix it. So we eventually proposed for take it back for the price he paid. He doesn't want. He thinks he can do better, but I don't know. I think like the business is gonna go down. So we've had 5 times, 4 for sure.
Oh, yeah.
5 is likely to happen, at least I believe. I don't know if they can turn around, but 5th might happen. So yeah, that's what you keep track of.
Yeah, man. It's really hard to find people, who are actually selling it and also care about what happens, once the store is sold. Because I talked to a few people about the same thing. I mean, really well-known people who, like one guy, really, really well-known talking about business acquisitions. I told him the same thing, like, hey, I'm happy to sell, but when I sell it, the buyers are not, able to like turn it around. Like maybe the buyer's not qualified and stuff. Like, what should I do? Should I go for more qualified buyers and stuff? And he was like, that's not your job. Like, your job is only until you sell it. Like, once you sell it, just forget it, just go on to a different deal. For me, I can't do that. So that was the reason I do very few deals. But man, I mean, yeah, you guys doing pretty good. So the another question I had was, like, let's say you put the listing, right? You put down the listing, and like someone like reached out to you and said, hey, like we are interested in it. Give us more details or whatever. Like, what does that process looks like once someone has reached out to you?
Yeah, very simple. When we reach out, we send them all the P&L and information memorandum. We jump in a meeting. We answer usually every questions they have. We get to know each other and go from there. I just ask for LOI. Sometimes they say, okay, you know what, give some time to think about. They come with follow-up on a second meeting. All is fine. And we just keep asking for an LOI. And then they send, and then we just go from there. It's like very straightforward. Give all the supply all the information beforehand. Have a meeting, business face to face, not just on the email, on the phone. You have to have some kind of connection in there. Build up rapport, just standard sales, and ask for LOI.
So is it more of like a typical sales process? You open a call, you kind of like pitch them on it, and then like, hey, like we need an LOI or something like that.
Yeah, that's it. Just push
Got it. So also, do you guys prepare everything up front to make sure like you don't waste time getting things when you're looking to sell, like the DD documents and stuff like that?
Yes, we usually have a data room ready. So we keep updating them as we go. Yeah. So we the moment we acquire the business, we already have the data room, and we just use the same for the exit, and we just update them as we go.
So if someone is listening to this podcast and like they do exactly what you said, what do you think are like couple of reasons, even after following what you said, they might not like get the same results as you guys are getting?
E-commerce is about speed. I think that's the biggest leverage. It's about speed, and everything revolves around it. Of getting the speed of knowledge. Like for example, if you take over a business and you don't know email marketing, if it takes you 6 months to understand email marketing, you're not going to see results. But if you can just open your laptop for every night, 1 hour, watch YouTube videos around Klaviyo, how to make an email campaign and what an email design, what a good email design looks like, you have a way big advantage of it. So that's one. It's about speed you should have. 2, it's team. If you're your first time acquirer, you don't have a team yet. You don't have the investment team yet. You don't have the operations team yet. You have to slowly build up, which is fine. It's also exciting, like especially if you're first time, you bring your own portfolio, you can choose to build your own team. Be strict on it. Don't go as quick as we did and hire the wrong people and have to fire them again and have to get new ones. Just focus on the team building part. That's also a big lever. And third is experience. So experience comes with time. The more experience you have around running e-commerce stores, doing the deals, the more easier it is for you to understand what's working, what's not working, what to do during challenges. For example, what happens if PayPal is holding your funds? It's very annoying. What do you do? Do you just let it be and just wait for it? Or you just, you have experience, you can call PayPal, you can push a little, you have an account manager you can go from those places. So I think those 3 will have the biggest difference on how successful you'll be.